Welcome to today's Explainer. We're jumping right into a dynamic, data-first breakdown of the oilfield services sector for the first quarter of 2026. Today, we're putting four of the absolute biggest players in the industry side by side: Baker Hughes, SLB, Halliburton, and Weatherford. We're going to strip away all the market noise and look directly at the hard numbers that define their actual performance.
So, throughout this analysis, we are going to answer one defining question. Which of these companies truly performed best in Q1 2026? Which ones face the most pressure? And most importantly, what do their financial results actually reveal about the broader state of the global energy industry right now?
Okay, let's dive into this. To really understand the numbers, we first have to understand the world these companies were operating in during early 2026. The macro environment was, well, incredibly complex. We saw widespread disruptions in the Middle East that practically forced companies to demobilize operations just to safeguard their personnel. Geopolitical risk has truly become a structural reality for the oil and gas market, and that's bringing renewed inflationary pressures right along with it. But at the same time, this volatility has pushed nations to heavily prioritize global energy security. That creates a massive long-term demand for the technology and services these four companies provide. Ultimately, it's this focus on energy security that dictates the fuel prices you see at the pump and powers the entire global economy.
Here is our roadmap for today. First, Baker Hughes. Second, SLB. Third, Halliburton. Fourth, Weatherford. And finally, number 5, a comparative scorecard and our industry takeaways. Section 1. Baker Hughes Q1 results. Let's take a data-first approach.
Looking right at the top line, Baker Hughes reported Q1 2026 revenue of $6.587 billion. Now, you might be thinking, hey, wasn't that an 11% dip sequentially from the end of 2025? And yes, it was. But the really important figure here is that it's actually up 2% year over year. That shows some serious resilience in their baseline growth, especially when you factor in the seasonal drop-off and those major geopolitical headwinds we just talked about.
Moving over to profitability. For those maybe a bit less familiar, adjusted EBITDA is just a simple measure of a company's core operating profit before complex accounting factors like taxes and depreciation get factored in. So, Baker Hughes posted an adjusted EBITDA of $1.15 billion. That is a massive 12% jump year over year from Q1 2025's $1.03 billion. Plus, they generated $210 million in free cash flow, proving they can efficiently convert their daily operations into actual spendable cash on hand.
The crucial point here is understanding exactly where that growth came from. Think of a backlog like a guaranteed pipeline of future work based on signed orders. Well, Baker Hughes' Industrial and Energy Technology segment was an absolute powerhouse. They booked $4.88 billion in orders. That's a staggering 54% increase year over year. This massive tech order intake beautifully offset their traditional oilfield services segment, which saw a 9% sequential revenue drop, largely because of those operational disruptions in the Middle East.
Section 2. SLB Q1 results. Let's evaluate their first quarter.
SLB reported a Q1 2026 revenue of $8.72 billion, which is a solid 3% increase year over year. But we really have to look under the hood here. This top-line number was significantly boosted by their recent acquisition of ChampionX. If you actually exclude that acquisition to get a pro forma apples-to-apples comparison with last year, SLB's baseline global revenue actually decreased by 7% year over year.
Now, what's really interesting about this slide is how SLB managed its profitability despite that baseline revenue drop. They pulled in an adjusted EBITDA of $1.77 billion. And while, that is down sequentially from the end of 2025, they still maintained a very strong margin of 20.3%. Furthermore, they still generated a really solid $487 million in cash flow from operations. They are without a doubt running a very tight, highly profitable ship.
Looking into their segments, SLB's Middle East and Asia region brought in $2.7 billion, but took a direct hit from the regional conflict, prompting them to demobilize operations. On the flip side, their production systems segment soared to $3.5 billion, a 23% year-over-year increase. Again, definitely aided by that ChampionX integration. Plus, management highlighted a really major strategic move, integrating S&P Global's data right into SLB's AI frameworks. This strongly signals that they are positioning themselves for a broad market recovery, which they're projecting for 2027.
Section 3. Halliburton Q1 results. Let's talk global scale.
For Q1 2026, Halliburton generated $5.4 billion in total revenue.
This perfectly sets up the sheer scale of Halliburton in our analysis. They are sitting very comfortably as a major global player, right in the mix alongside Baker Hughes and SLB when we talk about total market footprint.
For profitability, let's compare operating income versus net income. Operating income basically tells us how much profit the company made purely from its core services, drilling, completions, the whole shebang. Net income, on the other hand, is the final amount left over after taxes, interest, and any one-time charges are taken out. Halliburton showed incredibly strong fundamentals here, with a Q1 operating income of $679 million, which filtered down to a solid net income of $461 million.
Digging into their operational highlights, Halliburton saw very strong global software sales early in the year, right before a natural seasonal roll-off. But more importantly, management noted that their Q1 performance laid the absolute crucial groundwork for a recovery in North America. This sets them up beautifully for margin expansion and much stronger international contract pipelines as 2026 progresses.
Moving on to Section 4, Weatherford Q1 results. Let's look at their specialized impact. Based on their sequential data, Weatherford's estimated Q1 2026 revenue sits at roughly $1.15 billion. Now, they are absolutely a smaller player by pure volume compared to the first three giants we just looked at. But keep in mind, in the oilfield world, being a smaller player still means you're pulling in over $1 billion in just 90 days. They represent a highly specialized and absolutely crucial part of the oilfield services ecosystem.
And this next point brilliantly illustrates why size isn't everything. Weatherford's derived Q1 adjusted EBITDA was approximately $232 million, with a net income of around $108 million. When you actually calculate their estimated EBITDA margin, it sits at roughly 20%. This means that, dollar for dollar, Weatherford is competing incredibly tightly on profitability margins with the absolute largest giants in the industry.
Looking segment-wise, Weatherford's Drilling and Evaluation, or DRE, brought in $321 million. Their well construction and completion segment generated $443 million in Q1. A really massive operational win for them was their MPD technology. That stands for Managed Pressure Drilling. They saw phenomenal success in early 2026 deploying this tech, expanding it rapidly to 15 active units, all hitting high-performance standards.
Let's move to our final section and see how this builds together. Section 5, Scorecard and Industry Takeaways.
Okay, here is your Q1 2026 scorecard, side by side. SLB is the clear revenue leader at $8.72 billion, followed by Baker Hughes at $6.58 billion, Halliburton at $5.4 billion, and Weatherford at $1.15 billion. Now, a quick disclaimer. Because of differing accounting methods, adjusted metrics like EBITDA and operating income aren't perfect one-to-one comparisons across these companies. But what the numbers clearly show is that, despite the differences in volume, all four companies are executing with remarkably high profitability margins in a very tough environment.
Which brings us to our three major takeaways for the industry as a whole. First, Middle East operations are under intense short-term pressure due to conflict, and that's hitting the traditional services revenues of these companies. Second, the global drive for energy security is creating a massive boom in deepwater projects and technology-driven efficiency. I mean, just look back at Baker Hughes' 54% jump in tech orders. And third, because of supply chain vulnerabilities, management across the board is setting the stage for a broad, powerful upstream recovery that's expected in 2027.
I really want to leave you with this thought. With supply chains aggressively adapting right now and post-conflict commodity premiums expected to stay high, are the Q1 2026 results we just analyzed actually the quiet buildup to a massive 2027 energy supercycle? It is going to be absolutely fascinating to watch these four companies navigate the rest of the year. Thank you so much for joining me for this explainer, and keep learning.